Previous video, I discussed three popular recession indicators. I showed how trucking stocks could be a leading indicator for the S&P 500, but how do we easily compare price actions when these two ETFs have different values? Let's learn how to normalize asset prices in Python. First, we're going to get some import lines. We're going to do Y finance as YF for the abbreviation, and we're also going to get matplotlib as PLT. Now, we're going to start with a start and end date. So I'm going to say 2025 for the end date and 2000 for the start date. I'm going to want two distinct ETFs to compare against. So I'm going to use the transportation ETF, which is XTN. And then the end date, we're going to do the exact same line here, except now we're going to grab SPY. Okay, perfect. So now I want to know when the XTN first started trading because obviously the S&P was out for longer. So here you go. The XTN started trading, at least there's data starting in 2011. So I'm going to instead say start date 2011 so that both the S&P and the XTN in our data start on the same date. So XTN 2011, perfect. I could type in SPY to make sure it's the same, and that's perfect. Okay. So if you were to just go out and plot the XTN and the SPY together, it might look difficult to make some analysis on it because the prices are different. So we'll show what that plot looks like right now. Let's say dot close. We'll add a label to this one. We'll call it XTN. And then the color is blue. And then we'll have plt.plot SPY close. And then the label, we'll call it SPY. We'll do a different color. Let's call it red. Next, we'll give it a title, XTN versus SPY, close price. And then we'll give it a font size of 16. Let's also get rid of the grid. And then plt.plot legend. Let's put it in the best location that it could find. And then plt.show. So here you go. If you look at this, the SPY is like 6 times the price of the XTN share in that ETF. So trying to compare the two ETFs just by default on their own close prices can be very tricky to do since the S&P is at 600 while the XTN is at 100. So now we're going to normalize the prices as in create a start date, equal it to 100, and then see how the two ETFs play out. That way, when we plot it, it'll be normalized and the prices will be more similar for comparison. Next, we're going to normalize these prices so that we can do a better comparison. We're going to create a new column in both of our data frames. I'm going to call it XTN and we'll say normalized close price. And we'll have that equal to the XTN data frame. We're going to call the close column divided by close again, but we want the very first value. So I'm going to call dot ilock 0, multiply that by 100. So at the very beginning, both the S&P and the XTN ETF are going to be equal to 100. That way, both ETFs start with the same value. So we're going to index have 2011 be equal to 100. So we're going to create a new chart. We could say fig size 14 to 7. And then we're going to take the same colors that we did here. That way have some consistency. Normalize 0 will be the new close. And then we'll go back up here, do the same thing. And then we could say dot show. And now this is easier to compare against the two, right? Now that we indexed on 100, both of these ETFs can be on the same chart because the values are not as drastic. We can zoom in on this chart. Let's say, we're curious about, you know, let's look at 2015. There's a huge divergence here where the XTN Transportation ETF went down drastically compared to the SPY, which was kind of flatlined in 2015. So why don't we check out what's going on in 2015? We could do that with a new start and end date. So I'm going to guess and say 2015, zoom in, date, we'll call that 2025, or no, I want that to be like 2016 actually. We were zooming in on that. And then I can call the XTN data frame, but I want to actually create a new one called zoomed. So that way we could take the data in DFXTN and then extract only the start and end dates that we've entered. So this basically says return all the data between the start and end date. And then we're going to do the exact same thing for the SPY. So instead of XTN, we'll say SPY. And then zoom SPY. Okay. And then this will be the same. So I'm just going to copy this, paste it here. Instead of XTN, we'll do XTN zoomed, SPY zoomed. And then I could zoom in on this chart into 2015 to 2016. Here we see a drastic decline in the transportation ETF from a high of, say, 215, and then it goes all the way down to about 195, let's say. But the S&P was actually pretty flat. We see it between 160 to 170, and it's pretty constant between 160 to 170. So we see this divergence. XTN declines while the S&P stays stagnant. And then this is the 2015 flash crash. Chinese yuan was degrading in value, the currency was degrading in value, and there was also a flash crash. Um, I want to say it was like algorithmic trading based crash, but this could be a potential indicator that says, hey, maybe you have a trading strategy that says, hey, if the XTN and the SPY are diverging, one's declining while the other one's stagnant, or a more drastic case would be XTN's declining, but SPY is increasing. That could be a signal that says, hey, the transportation sector is declining, but the S&P still isn't showing that decline. Transportation is a huge part of the economy and can be a leading indicator because if there's less shipments, less goods being shipped around because of less purchasing, then what does that mean for the economy? People are spending less, people's budgets are tighter. That might lead to lower earnings for the SPY when the earnings release or what have you. So this is how you can use indexing equals 100 and compare two assets with differing prices into one single chart to help do some analysis. So I hope this video was helpful and this coding video was helpful for you guys. Check out intrendias.com for free buy and sell signals based on technical analysis on your favorite stocks, cryptos, and check out other YouTube videos on my channel for more coding tutorials. I'll catch you guys in the next one.